Looking to trade like a professional? Then you can't afford to miss Fibonacci retracements. This powerful tool helps you spot entry points and maximize profits. In this video, I'll teach you how to use Fibonacci retracements the right way, to identify the best buy and sell zones, and most importantly, how to avoid the common mistakes that hold traders back. This video is perfect for complete beginners, so don't worry if you're new to trading. I'll guide you step by step through the process. By the end of this video, you will be able to accurately draw Fibonacci retracements, use them to spot high probability trades, set stop losses based on Fibonacci levels, combine Fibonacci retracements with other indicators and signals to strengthen your strategy. But what exactly is Fibonacci retracement? Well, it all starts with a fascinating number sequence that appears repeatedly in nature. This sequence creates a unique mathematical relationship found everywhere in the world around us. You can see Fibonacci patterns in the spirals of seashells, the arrangement of sunflower seeds, the branching of trees, and even in the proportions of the human body. It's nature's way of maintaining balance and harmony. But here's the truly amazing part. These same patterns also appear in financial markets. Price movements often follow Fibonacci ratios, creating natural support and resistance levels. The most important Fibonacci retracement levels in trading are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. The 61.8% level, also called the golden ratio, is considered the most significant, as price often reacts strongly around this zone. Many traders look at this level for potential reversals or continuation of a trend. But how do we actually draw Fibonacci retracement on the chart? First, we need a good charting tool. I recommend using TradingView. The link is in the video description. Once you're on TradingView, follow these steps. First step, identify a trend. Before drawing Fibonacci, we need a clear trend. Is the market in an uptrend or downtrend? The tool works best when price moves in one direction and then pulls back. I will show you a trick. Add the EMA to your chart. Set the length to 200. But we will change the time frame of the EMA to the next higher time frame, which would be the 4-hour time frame. This means we are still looking at 1-hour candles, but we'll see the 200 EMA of the 4-hour chart displayed on the 1-hour chart. This gives us a longer-term perspective and helps us filter out the noise from smaller time frames, allowing us to better identify the overall trend when applying Fibonacci retracements. Above the EMA, it's an uptrend, so we're looking for long opportunities. Below the EMA, it's a downtrend, so we're looking for short opportunities. Find the Fibonacci tool. On the left-hand side of your screen, click on the Fib retracement tool, and then first click on the start of a movement and pull it to the lowest part of the movement. Then click on the settings and make all of the levels invisible. We don't need those right now, as we're focusing only on the main Fibonacci levels for now. This will help simplify the chart and make it easier to see the key areas that we're working with. But what does this tool tell us now? In this example, the Fibonacci retracement shows that we have retraced 61.8% of the entire move from the high to the low. This means that after a strong downward movement, the price has pulled back about 61.8% of the total move. So, if the price finds resistance at this level and starts to move downward again, it could signal the continuation of the downtrend. But just because the 61.8% level is the golden level doesn't mean we can't get support at a higher level, like the 50% level. In some cases, price may find support or resistance at these levels instead of the 61.8%. The Fibonacci levels act as potential zones for reversals, but they aren't guaranteed. It's important to always look for confirmation from other factors, such as price action or additional indicators, to strengthen the probability of a successful trade. Here we have another example to make this clearer. We are above the EMA, so we're looking for long trades. Then we draw the retracement from the start of the movement to the highest point. Now we can see our levels again, and we see that right now we're at the 78.6% level. This is a good level for a possible reversal, as price may find support here and bounce upwards, potentially continuing the uptrend. Now, something important. The higher levels, like 23.6% and 38.2%, aren't as strong as the lower ones. So, as beginners, you should avoid taking trades from these levels, as they are less reliable for price reversals. Now, I will show you how to use Fibonacci retracement to set your stop loss. Simply draw the retracement on the chart. Wait for the price to hit a key level. Enter the trade, place your stop loss below the next lower level, and set your take profit at twice the risk for a 1-2 risk-reward ratio. Now I'm going to show you the mistake that the trader makes most often when using Fibonacci retracement. Namely, they use the Fibonacci retracement in time units that are too small. The problem is that the Fibonacci retracement is mainly used by large institutions that tend to operate in higher time frames, which means that in low time frames, you can simply expect more false signals. The second big mistake that the trader makes is that they simply go into a signal without really waiting for confirmation, because it is always possible that we touch a certain level but then continue our trend. So it would always be smart to connect our signals with the help of other moving averages or even trend lines and engulfing candles we find. Thank you for watching this video. I hope the information was helpful to you. If you enjoyed the video, make sure to leave a like and subscribe to the channel so you don't miss any more tips and strategies. See you in the next one.